Welcome back to Talk Tickers, the show designed specifically for the buy-side mind. We aren't here to read you the headlines you already saw on your terminal.
No, not at all.
We are here to strip away the noise, ignore the retail panic, and look strictly at the signal.
That's the job.
Today, we are dissecting the Q4 2025 print for a company that has, effectively been the #2 giant in China tech for 2 decades, NetEase, ticker symbol NTES.
And it is a fascinating setup today because what we have here is a classic clash of narratives. It's the old world of earnings misses versus, well, the new world of AI industrialization.
We absolutely do. And before we even get into the weeds of the P&L, we have to address the tape. We have to talk about the elephant in the room.
You have to.
The stock is down. We saw it slip, about 2% in the pre-market, and that selling pressure just extended right into the regular session, closing down roughly 4.1%. The street is punishing this headline miss.
Oh, they are?
There is no sugarcoating that price action.
No, there isn't. And look, the market is looking at a top and bottom line miss. And in this environment, with the kind of volatility we've seen in KW Web and just broader China tech, investors have zero patience for surprises.
None.
But here is the tension of this entire deep dive. This is the real story. Investors are selling the financial miss. They're selling the now. But management spent the entire hour on the call selling a massive paradigm shift into AI. They're selling the future.
That is exactly the friction point. I think the core question we need to answer in this hour is, well, it's simple. Is this AI narrative a distraction?
Is it smoke and mirrors?
Exactly. Is it just to cover up a soft quarter? Or are we actually witnessing the industrial revolution of gaming finally arriving and the market is just too short-sighted to see it?
I think it all comes down to your time horizon. I really do. Are you trading the quarter or are you allocating capital for the cycle? Management is betting the house on the ladder.
Okay, so here is our roadmap for the discussion. First, we are going to perform a forensic analysis of the ugly, the revenue and EPS numbers that caused that sell-off. We need to understand why they missed.
The mechanics of it.
The mechanics. Then we pivot to the beautiful, or at least what management claims is beautiful. The whole AI narrative, the industrialization of their workflow, and this concept of, sentient NPCs.
Which is a whole other rabbit hole.
It is. Then we'll look at the pipeline global expansion and what's coming in 2026. And finally, you'll want to stick around because we have this is not financial advice trade pitch that, let's just say it involves betting on a sentient economy.
It is certainly a creative interpretation of the data, but I think the logic holds up if you squint.
If you squint just right. Okay, let's start with the cold, hard facts. The headline numbers. Revenue came in at RMB 27.5 billion.
Which translates to approximately 3.9 billion in US dollars.
Right. And for context, that is a miss.
A clear miss. Not a huge one on the top line, but a miss nonetheless.
Yeah. It is. The consensus was looking for something closer to, 3.94 billion. So we're talking about a roughly 3.8% miss on the top line. But where it really hurt was the bottom line.
That's where the pain is.
Non-GAAP EPS came in at $1.58 per ADS.
And the street was sitting at $1.85.
That is $1.27. We're talking about a 15% whiff on earnings per share. Now, I have to play devil's advocate here for a second.
Please do.
When you miss earnings by 15% in this market, that usually implies something is broken. Is something broken at NetEase?
Broken is a strong word. I don't think broken is the right word, but maybe misaligned is. We need to drill into the mechanics of this miss because just saying seasonality feels like a lazy excuse for a nearly 4% top-line whiff, but there's some real nuance there.
Go on. Unpack that for us.
Okay, so if you look past the headline and you look at the deferred revenue balance on the balance sheet, the story changes slightly.
The unearned revenue.
Exactly. NetEase is sitting on a massive pile of cash collected from gamers that they haven't recognized as revenue yet. Remember Q3 of 2025?
The Identity V event. It was huge. Put up massive numbers.
It was a monster. That was a huge cash influx and an immediate recognition event. What happened in Q4 is that the cash flow is actually still there. The billings are quite resilient. But the accounting recognition rules for some of their newer MMO titles and some of the legacy adjustments, they're pushing that revenue recognition into 2026.
So just to be crystal clear for everyone listening, the cash is in the bank, but the accountants haven't let them claim it on the income statement yet.
That's a perfect way to put it. It's a timing mismatch, not a demand collapse. That's a critical distinction. If you look at the value-added services line within the segments, it actually held up better than expected.
So where was the drag?
The drag was specifically in the PC gaming segment. And here's a key detail from the call, a little bit of subtext. They pulled back on marketing spend for legacy titles in Q4.
Okay, but why would you do that? If you know the numbers are looking soft, why would you pull back on marketing? Isn't that when you press the gas?
Not if you're trying to save your dry powder. They are preparing for the full global launch of Marvel Rivals and the next big marketing wave for Where Winds Meet. This feels like a capital allocation decision.
So they're starving the old cows to feed the new calves.
That's it. It's not a failure of the product, it's a strategic choice. They're reallocating resources for the bigger battles ahead in 2026.
Okay, so what you're saying is the big EPS miss is at least partly self-inflicted because they are hoarding marketing dollars for Q1 and Q2 of 2026.
That is the read. It looks like a tactical retreat in Q4 to secure what they hope will be strategic victory in 2026. But here's the problem.
The algorithm.
The algorithm doesn't care about your strategy. The quant funds, the algos, they just care that the EPS number was $1.58 instead of $1.85. End of story. Sell signal.
Let's talk about that hangover effect, though, because Q3 was a party, so Q4 is just the cleanup.
Effectively, yes. I mean, the comparison period is brutal. Q4 2024 had incredibly high seasonality, so your year-over-year growth number looks ugly.
Right.
And then sequentially, coming off that Q3 sugar high from the Identity V summer event, of course, everything looks muted in comparison. It's just a tough comp all around.
And what about the licensed games?
That's the other piece. There is a shift in the revenue mix. The revenue from licensed games is fluctuating, and that impacts the top-line recognition differently than their self-developed titles, which, is where the real margin is anyway.
Okay, so the headline numbers are soft, and we have established that it's partly accounting timing, partly marketing timing, partly just a tough comparison. But let's look for the silver lining here, because for a long-term holder, the margin story is, well, it's fascinating.
This is the crucial pivot in the entire story. If you are a long-term holder, you stop looking at the revenue line and you start really staring at the gross margin line.
Which ticked up to 64.2%.
Up from 60.8% year over year.
That is a significant jump. In a mature business like this, expanding margins by nearly 400 basis points is incredibly difficult to do.
It is huge. It basically means that even though revenue is soft, so they aren't bringing in as many dollars as expected, they are squeezing significantly more profit out of every single dollar they do bring in.
Walk us through the mechanics of that. I mean, how do you expand margins so aggressively while you're missing revenue estimates?
It all comes down to the product mix shift. They are shifting heavily, and I think more aggressively than the market realizes, towards self-developed games.
Their own IP.
Their own IP. When you make the game yourself, you keep the whole dollar, more or less. When you license a game, say from a Japanese studio or a Western partner, you are paying royalties right off the top. As that portfolio tilts more and more toward their own IP, the margin naturally expands.
So it's just less revenue sharing.
Less revenue sharing is a big part of it, but they're also lowering platform costs. They are getting smarter and more efficient at channel distribution, at user acquisition. This is the definition of operating leverage. They are becoming a more efficient machine, even if the fuel intake slowed down a little bit this quarter.
And speaking of fuel, we have to mention the balance sheet. I mean, it is a fortress.
It's not a fortress, it's a war chest. Net cash is sitting at RMB 163.5 billion.
Which is roughly $23.4 billion USD.
Just think about that number for a second.
It's absurd. They could buy a small country with that cash. Or, more realistically, they could buy a major publisher like Ubisoft or CD Projekt Red outright and still have billions in change left over.
Or they can just buy themselves.
Which they are actively doing.
Exactly. They approved a dividend of $1.16 per ADS. That's nice. But more importantly, they extended the buyback program all the way out to January 2029.
And they've been using it.
Aggressively. They've already spent about $2.0 billion repurchasing 22.1 million ADS.
So management is effectively standing in the market and saying, we know the stock is down, we see the price, we have $23 billion in cash, and we are going to keep buying our own shares because we think you guys are wrong.
Actions speak louder than earnings calls. Buying back stock, especially with that kind of firepower, is the ultimate vote of confidence. When you have that much cash, you effectively set a floor on the stock price. It's very, very hard to bet against a company that has $23 billion in the bank and an active buyback desk.
Let's break down the other segments quickly before we get into the heavy tech discussion. Games, obviously, is the core engine at RMB 22.0 billion. But what about the side bets? How's cloud music doing?
Cloud music came in at RMB 2.0 billion. It's growing steadily, it's a solid business. But the really interesting story from the other segments is actually UDAO.
the education arm. This has been a roller coaster for years with all the regulatory crackdowns in China.
It has. I mean, this business was left for dead by a lot of analysts. But look at the milestone here. RMB 1.6 billion in revenue, which is solid, but crucially, it achieved its first ever net cash inflow from operations.
That is a massive pivot. For years, Yudadao was a cash incinerator.
It was. It was the classic growth at all cost venture that got absolutely hammered by policy changes. Turning that corner to positive operating cash flow means it's no longer a liability on the consolidated balance sheet.
It's paying for itself now.
It's becoming a self-sustaining asset.
Yeah.
And even if it's not a huge growth driver going forward, just stopping the bleeding is a huge win for the consolidated statement.
And innovative businesses, the last piece, was down about 10.4% year over year. So really, the story remains the same as it's always been. NetEase is a gaming giant with some interesting side hustles that are finally cleaning up their act.
Exactly. The side hustles are maturing, which is good financial hygiene, but the alpha, the real growth, is in the games.
Okay, let's pivot. Let's get into the deep dive portion of this show, because if you listen to the call, if you listen to CEO William Deng and his team, you would think they just discovered fire.
Yes, that's a good way to put it.
They refused to get bogged down by the myths. They don't want to talk about Q4. They pivoted so hard to AI.
It was a very deliberate strategy. You could feel it. They know the numbers were soft. So what do? You change the conversation. You stop talking about last quarter's receipts and you start talking about the next decade's infrastructure.
Their quote was, and I wrote this down, AI is not a replacement for human creativity. It is a force multiplier. We hear that buzzword a lot, force multiplier.
All the time.
But usually it feels like corporate speak for, we bought a ChatGPT subscription to write our marketing emails.
Right. Or we use Midjourney to make mood boards for our artists.
Exactly. But NetEase seems to be arguing something very different here. They are arguing for a foundational competency, not just a tool, but a new way of building.
And they have the receipts to back that claim up, at least in terms of timeline. This isn't something they started in 2023 when the hype cycle hit its peak.
No.
They've been building the Fuxi Lab since 2017. They have a dedicated game AI lab. They treat AI research much closer to academic science than traditional tech development. This has been a long-term R&D project for them.
I have to push back on this generational investor pitch, though. I mean, come on. Every single company in 2025 is pivoting to AI to distract from slowing growth. Why should I believe NetEase is actually industrializing AI and not just, buying a bunch of NVIDIA H100s to look cool on an earnings call?
That's fair skepticism.
Hey.
And usually I would be right there with you. But look at the R&D line item in the financials. Look at the numbers.
It's flat. It's stable at 15.7% of revenue.
Exactly. It's flat.
Which implies they aren't spending enough, doesn't it? If this is an industrial revolution, shouldn't CapEx and R&D be exploding? Should they be pouring money into this?
Not if the tools are actually working. That's the paradox here. If their DreamMaker tool actually reduces asset production time by 90%, like they claim, then their R&D spend should stay flat while their output doubles or triples.
Oh, okay.
The fact that they aren't blowing out the budget might actually be proof that the efficiency thesis is real. You're measuring the output, not the input.
So you're saying the flat spend is actually a signal of extremely high efficiency, not low ambition. That is a very contrarian take.
It is, but that's what their narrative suggests. They mentioned DreamMaker and Bing, specifically on the call. These are not just chatbots. These are asset generation pipelines. Management specifically mentioned a qualitative shift in developer habits.
That phrase stood out to me too, qualitative shift. It sounds like jargon, but it feels important.
It's very important. It means the behavior of their employees is changing. Developers aren't using AI to, say, write a single line of code anymore. That's the old way. They're using AI to solve a complete development task.
Give me an example.
Okay, so instead of asking AI, write the C++ code for a polygon, they're saying, build me a photorealistic medieval-style bridge across this canyon that can support the weight of a dragon. The scope of the ask has changed.
From a line of code to an entire asset.
Exactly. From a task to a solution. So if you are an investor, the bull case here is that they are decoupling the cost of production from the scale of the game. Precisely. In the old world, if you wanted a game world that was twice as big, you needed twice as many artists. You needed to double your headcount. In the NetEase industrialized AI world, you just need more compute. And at scale, compute is cheaper than artists in the long run.
Now, here's where it gets really interesting for me. And this was my favorite part of the entire call.
The Q&A.
The Q&A. There was a specific question from an analyst about Google's Genie project. For listeners who don't know, Genie is this new AI model that can basically generate a playable 2D game from a single image or a text prompt.
It's the text-to-video concept, but the next evolution. It's text-to-interactive gameplay. It's mind-blowing stuff.
It is. And the fear from the analyst was, if Google or someone else releases this to the public, does the barrier to entry for making games drop to zero? Does a kid in a basement with a good idea suddenly become a direct competitor to a multi-billion-dollar studio like NetEase?
This is the ultimate moat question, right? If anyone can make a game with a sentence, is your entire business model worthless?
And management had a fantastic rebuttal. They used the Hollywood camera analogy.
I loved this. It was so smart. They said, look, when handheld cameras came out and then smartphones came out, the barrier to shooting video dropped to absolute zero. Everyone became a cameraman.
Right.
Everyone could shoot 4K video from their pocket.
Right.
But did everyone become Steven Spielberg?
No. We got a lot of cat videos and TikTok dances, but we didn't get more blockbusters.
Exactly. They argued that while the floor is lowered, anyone can make something. The ceiling for a hit is actually raised. To make a Hollywood-level movie or a AAA game, you need more than just the ability to generate pixels.
You need integration.
You need complex integration. You need economic systems that are balanced. You need social ecosystems that are compelling. You need, and this is their word, taste.
That was the key phrase for me from the whole call. Soft skills become more scarce.
It's a profound insight. I mean, think about it. In a world where AI can build the building, the architect who designed it becomes infinitely more valuable, not less. The person who knows what to build and how to make players feel something, that is the new scarcity.
So NetEase is betting that their 10,000 developers are the architects, not the bricklayers. The AI is the bricklayer.
That's the entire thesis. They're essentially saying, let the kids play with Genie. Let them make their little platformers. We are building worlds.
But let's apply this to a current product. Let's make this tangible. Let's talk about the NPCs and where wins meet.
Yes, let's talk about this, because this isn't theoretical AI hype. They have 10,000 AI-powered NPCs in this game right now.
And we know AI NPCs can make the world feel more alive. They can have unscripted conversations. But let's translate that to the P&L for the buy-side listener. How does a sad, bread-stealing NPC help the bottom line?
Because it solves the content treadmill problem.
Okay.
The single biggest ongoing cost in an MMO is churning out new quests every single month so that your players don't get bored and churn out of the game. You need teams of writers, designers, artists.
The live ops team.
The live ops team, which is hugely expensive. If the NPCs are generating their own drama, their own sad stories based on underlying simulation logic, you effectively lower your live ops content cost to near zero.
It's procedural generation, but applied to narrative instead of just, the layout of a dungeon.
Exactly. Management described NPCs that actually struggle with poverty in the game's economy. They might resort to petty theft in the village. They have routines, they have needs, they have desires. They exist even when you aren't looking.
So the idea is, if I'm a player and I follow a random NPC around, I might discover a whole storyline that no human writer ever scripted.
That's the dream. You might see him get arrested for stealing bread because the simulation decided he was hungry and his farm had a bad harvest. And maybe that kicks off a whole emergent quest to clear his name or break him out of jail.
Okay, so now I see the P&L connection. If that emergent story keeps me logged in for an extra hour, that is higher engagement.
And if you increase average engagement time by, say, 20%, because the world is dynamic and unpredictable, while simultaneously cutting your content production costs by 40%, your gross margins on that specific game title expand significantly.
It's the operating leverage event that the market is missing.
That's what they're betting on. It's the holy grail of gaming. Low cost of production, high player retention, infinite self-generating content.
If they pull that off, the earnings miss in Q4 2025 will look like a rounding error in the history books.
If they pull it off, that is the big if. But while we dream about the future of AI, we have to respect the past. Because NetEase has a cash cow that just refuses to die.
The legacy engine. Fantasy Westward Journey.
An absolute legend of a game.
This game is 23 years old. It can legally rent a car in the United States. It can drink. And it just hit a record high annual revenue number in 2025.
That is shocking.
How does a 23-year-old game hit a revenue peak? That defies gravity.
It's completely unheard of in Western gaming. You don't see, World of Warcraft hitting peak revenue 20 years later. Well, maybe with the classic servers, but not consistently on the main game. NetEase has just mastered the art of the live service.
They mentioned this unlimited server model on the call. What is that mechanically? What does it mean?
It's a very clever strategy to lower the barrier for lapsed players to come back. Think about it. If you played a game 10 years ago and you try to log back in now, it is intimidating.
Immensely.
Everyone is level 100 with glowing armor. The economy is hyperinflated. The gold you had is worthless. It's overwhelming.
Right. You feel like you're entering a hyperinflationary economy with a wooden stick and some cloth pants. You can't compete.
Exactly. The unlimited server basically restructures the economy. It simplifies the grind, but, and this is key, it keeps the free trading aspect that players love. It's essentially a fresh start server that taps into nostalgia, but fixes all the friction points that prevent old players from coming back.
So it's the WoW classic strategy, but modernized with smarter economic controls from the start.
Precisely. It resets the economic clock, inviting all those millions of churned players back in to spend money all over again. And this is the buffer. This is why investors can sleep at night despite the Q4 miss.
Right.
As long as Fantasy Westward Journey continues to print money, NetEase can afford to miss a quarter. They can afford to spend billions on AI R&D. This is the solid foundation that funds the speculative skyscraper they're trying to build.
But they can't just rely on China forever. We know the domestic market is saturated. We know the regulatory environment can be tricky. The real growth has to come from outside of China. And this quarter gave us some really solid data points on that global push.
It did. And the headline there, without a doubt, is Marvel Rivals.
Named Time's Best of 2025. That's a nice little accolade to put on the box.
It's massive validation. It's not just some niche gaming site. And it's not just critical acclaim. Season 6, the one featuring Deadpool, drove the game to #1 in the US and Canada.
That is the metric that matters. Beating Western developers on their home turf with their own most prized IP. This isn't a mobile game we're talking about, right?
No, this is PC and console. It's a hero shooter. That is a genre the Chinese studios have typically struggled with. It proves that NetEase isn't just a Chinese mobile developer anymore. They are a legitimate, global, multi-platform player.
It's almost embarrassing for some Western studios.
I mean, you could argue they are handling the Marvel IP better than some Western studios have. I won't name names, but...
We know who you mean. And Where Winds Meet is also going global in a big way.
A huge way. 80 million cumulative players. It ranked #2 on the Steam Global Top Sellers list.
That's so interesting to me because it's a wuxia game. It's martial arts. It's a very culturally specific Chinese genre. Usually those don't travel well. Western gamers like Knights and Dragons or Space Marines.
That has absolutely been the conventional wisdom for decades. But look at the success of Black Myth, Wukong recently, and now this. I think the West is just hungry for new aesthetics.
They're tired of European fantasy.
They're tired of the same fantasy knight and dragon trope. Wuxia, this idea of flying through the air, these incredible martial arts, the Eastern philosophy, it feels fresh and exciting to a Western gamer. NetEase is capitalizing on that cultural export.
It's the Crouching Tiger, Hidden Dragon moment, but for interactive gaming.
That's a great analogy. And we can't forget the reunion, the big one, the Blizzard partnership.
The Return of the King. World of Warcraft and StarCraft 2 back online in China.
And they cited record high annual revenue for Blizzard titles in China.
It's so funny how they broke up, had that messy public divorce, the servers went dark for a year, and now they are back together and making more money than ever before. What is the psychology there?
I think it's just absence makes the heart grow fonder. The pent-up demand was massive. You had millions of Chinese gamers who lost their digital homes, their online communities, for a year.
It's a big deal.
When the servers came back up, they didn't just log in, they spent. They bought the expansion, the mounts, the passes, everything they missed. It's a classic revenge spending phenomenon.
So we have the legacy engine firing on all cylinders. We have the global expansion clearly working. But markets are forward-looking mechanisms. They care about 2026. What is in the pipeline? This is where I personally start to get a little nervous.
And you should. This is where the risk in the story lies.
Yeah.
The pipeline is ambitious, but it has to deliver. There are no guarantees.
The big name they threw out was Sea of Remnants. Target launch is Q3 2026.
Technical testing started on February 5th. So it's real. It's in players' hands, at least in a limited way.
The vibe they described was a naval journey, open world, distinctive art style.
And my alarm bells immediately start ringing. Naval games are a graveyard genre.
Right.
Ubisoft spent a decade trying to make Skull and Bones work, and it came out. Sea of Thieves took years to find its footing. Why does NetEase think they can succeed where some of the biggest Western AAA studios have failed?
That's my question. Is this just another boat shooter? Because that doesn't work.
I think it comes down to the architecture.
Yeah.
Ubisoft tried to make a naval shooter. NetEase, from what we can tell, is describing Sea of Remnants as a simulation-first RPG. The leaked technical test footage shows a deep economy system that relies on trade routes, not just cannon fire.
So it's more like EVE online on a boat than Assassin's Creed, Black Flag.
That is the bull case. If they create a true player-driven economy where you need to form guilds to protect trade convoys from pirates, you create sticky social reliance. That's very different from go shoot that ship.
Yeah.
But the risk is pure execution. The tech. Water physics alone are a nightmare for server latency. If they don't nail the netcode, this game sinks on day one. Pardon the pun.
Okay, then there is Ananta.
Now this is the one to watch. The one with the highest potential and highest risk. Urban open world.
That sounds like code for a GTA competitor.
Or at least a competitor to Cyberpunk or Insomniac's Spider-Man. Urban open worlds are the most expensive, most difficult games in the world to make. You need traffic systems, crowd AI, verticality, interiors. If they pull off a high-quality, stable urban open world, that is a massive technical flex. It's the hardest technical challenge in gaming.
A huge if. And then we have the weird one, auto chess.
The oddball of the bunch.
I have to be honest, when I heard auto chess strategy for 2026, I just scratched my head. Isn't that genre? Done. It feels like Riot Games won, Teamfight Tactics or TFT has the market cornered, everyone else went home.
It's a saturated market for sure.
So why is NetEase entering a mature category that's already dominated by a monopolist? It feels like a waste of resource.
It's a valid skepticism. The management's argument on the call was all about differentiation through Chinese demon and ghost culture.
So spooky chess.
Basically, yeah. They argue the genre mechanics are proven. People clearly like this type of game. But they think players are bored of the League of Legends, high fantasy aesthetics. They think they can win on narrative tension and just a cooler, darker visual flair.
Is that enough of a moat?
It's a gamble. But we have to remember, NetEase is very good at taking a known genre and adding a very specific high-quality polish to it. Remember Knives Out and Rules of Survival.
Yeah.
They did it with Battle Royale before PUBG Mobile really took over the global market. They know how to iterate. But yes, entering a saturated market is always, always tougher than creating a new one.
They also gave a brief mention to Rusty Rabbit, but clearly the weight of expectation is on Sea of Remnants and Ananta.
It is. And notice the guidance themes, or rather, complete lack thereof.
Right. No formal quantitative guidance for 2026.
Typical NetEase. They don't give you a spreadsheet with quarterly targets. They give you a philosophy. The focus is on delivery. Management's tone was cautiously bullish, but they were essentially asking investors to trust the R&D conversion. They're saying, we spent the money, the games are coming, trust us.
So let's bring this all back to the listener. The person staring at their portfolio, seeing NTS down 4% and wondering what to do. What is the so what of this entire call?
The so what is a fundamental disconnect in timelines. The stock is down 4% because the market wanted to beat today. They wanted an EPS of $1.85 today.
They wanted immediate gratification.
Yes. And NetEase gave them $1.58 and a long lecture on the potential of AI in 2027. It's a mismatch of expectations.
It is.
And you can see that in the valuation. Look at the relative performance. NetEase's one-year return is about 13%. KW, the China Internet ETF, is up about 23% over the same period.
So NetEase is lagging the broader China tech recovery.
It is, which implies it might be cheap relative to its peers. That frames the whole debate.
So what's the bull case?
The bull case is you buy this dip. You buy it if you believe the AI force multiplier story. If you believe that in 2 years, their margins will explode because AI is making half the game for them and player retention will double because the NPCs are live, then this price is an absolute gift.
And the bear case.
The bear case is that the pipeline is just too risky. Sea of Remnants might sink. Ananta might be a buggy mess. And the Q4 miss suggests that the legacy portfolio, even the mighty fantasy westward journey, might finally be hitting a ceiling.
An air pocket.
Exactly. If the old stuff slows down before the new stuff kicks in, you have an air pocket in earnings. And stocks absolutely hate air pockets.
It's a classic transition risk. They're crossing the chasm from the old mobile-first era to this new AI-driven global era. And the bridge is a bit wobbly right now.
But they do have $23 billion in cash to steady the bridge. That helps.
It certainly does. Okay, we have covered the numbers, we've covered the narrative, and we've covered the risks. Now it is time for the segment that our lawyers love to hate.
The disclaimer segment.
Precisely. This is not financial advice. We need to be very clear. We are not financial advisors. We are not hedge fund managers. We are two voices in your headphones. Do not trade on what we are about to say.
Please go.
This is for entertainment and educational purposes only. If you lose money, do not email us.
I will not reply.
But in the spirit of the buy-side mind, we like to pitch one outrageous but plausible trade idea that's born from the subtext of the earnings call. Something a junior analyst might pitch to their investment committee after 3 espressos.
Okay, I'm ready. What have you got for me today?
I call this trade the ghost in the shell arbitrage.
Okay, you have my attention. I'm listening.
Here is the thesis. Management explicitly said 2 things on the call that stuck with me. Data is more important than computing power, and vertical models beat general models.
Right. Specificity wins.
And they also said their NPCs have lives, they experience poverty, they resort to theft, they struggle, they are economic actors.
Okay, I see where this is going.
My trade is long NetEase, NTES, short generic AI plays. But the specific kicker is this. I am betting on the sentient economy.
Go on, define that.
We are betting that by Q4 2026, NetEase launches a game, let's say it's a Nanta, where the NPCs are so advanced, they don't just provide content for the player, they generate their own microtransactions.
Wait, what? Explain that. The NPCs sell things.
Imagine an MPC that is a merchant in the game. It uses a proprietary NetEase AI model to analyze the entire player base in real time. It figures out exactly what item is in highest demand, it uses another AI to craft that item, and then it sets a dynamic price and sells it to players on the in-game auction house.
So it's running the game economy without a human live ops team.
The AI is the developer, it is the economy manager, it is the content creator.
So you completely remove the middle class of game development. You remove the entire live ops team, the economy balancers, the content patch designers. The game patches itself. It evolves on its own.
Exactly. The game becomes a perpetual motion machine of revenue. Your gross margins don't just expand, they explode. They go from 64% to 85% or 90%.
That is a terrifying and brilliant idea.
And the trade structure is this. You buy long-dated call options. Specifically, you buy calls dated for January 2027. Why that date?
Because that matches the extension of their new buyback program.
You got it. You align your own timeline with the company's own wallet. You are betting that this AI-driven industrial revolution of gaming pays off right as the company's share repurchases are peaking.
It's plausible. If they actually have 10,000 NPCs simulating poverty, simulating a supply and demand economy is the very next logical step. It's like the Matrix, but profitable.
Plausible, but terrifying. That's the talk ticker's guarantee.
I give that a 20% chance of actually happening by 2027, but if it does, the stock doubles, minimum.
There you have it, the ghost in the shell arbitrage.
But again, don't actually do it.
Definitely don't do it. All right, let's wrap this deep dive up. A quick recap for the listeners on the go.
NetEase misses on the top and bottom line for Q4. The street is grumpy. The stock takes a roughly 4% hit on the day.
But management completely ignores the miss and doubles down on AI, not as a gimmick, but as a full-scale production revolution. Force multiplier is the phrase of the day.
And while that future is being built, the global engine is firing. Marvel rivals and where winds meet are proving they can win outside of China on PC and console.
So the question we leave you with is this. Does the AI narrative justify the earnings miss? Is William Ding building the future of entertainment, or is he just buying time to fix a slowing legacy business?
That is the multi-billion-dollar bet you are making if you buy the stock today.
Tell us what you think on the platform. Keep your eyes on the tape. We'll talk to you next quarter.
Stay sharp out there.